Hi all, welcome back to our YouTube channel. We hope you all are doing well and preparing well for your exams and studying hard to get good results. So let's proceed. Topic that we have today is from FRM as well as CFA level 2. It's also from FRM 1 also. Some part of it is there in your financial markets and products and in learning objective mortgage backed securities. Over there, it's uh, some introduction part of option adjusted spread is there. But the question that we will have a look at today is slightly in detail. So it can be categorized as slightly higher level. And we will see, yeah, option adjusted spread some more or less it's related to bonds with embedded options in it. And yes, before we go ahead, please do subscribe to our channel, like, share, and comment as well. Do share with your peers who are preparing for these exams. So this is a question that was asked in one of the forums as a query. So we have been given four statements and we have been asked to verify which one is true in context of option adjusted spread and Z spread for bond that is trading at par. Which one is correct? So like these are the options that we have to explore. Before we go ahead, we need to understand few things. I mean, this is a background that you need before you explore this question. So you need to understand what is callable bond, what is puttable bond. In general, what are bonds with embedded options, and what's the spread, and what's the relationship between the spread and OS, that is option adjusted spreads. Once you know these, then you will be in a better position to choose the right answer. So let's see. So the XY graph that you see on the screen is on x-axis, it is say interest rate or yield, and on y-axis it is bond price. So as we know that bond price is inversely proportional to interest rate. So as and when our rate decreases, so currently say when you bought a bond, somewhere interest rate was here and it goes down, then your price is going up. So this particular curve that you see here is, I'll touch upon this dotted line, but yeah, this is a usual relationship between bond price and yield. So as your yield decreases, your bond price goes up, and as your yield increases, your bond price goes down. So, and it has some logical reason behind it, and but yeah, currently that's not much in scope. So we assume that you know that. So yeah, it's inverse relation, but so you can call this as a straight bond. When I say straight bond, it means that a bond with no embedded options. So there is no optionality in this bond. But if there is a optionality in the bond, now be very careful. So if there are options in the embedded options in the bond, so say callable bond. So when issuers have the options to call, so like when you being a bondholder, if you give an option to call bond to issuer. So like in a way, say for example, we are bondholders and we are giving a right to bond issuer that he can call it at any point in time. Then like somewhere it can be tagged as a callable bond, because if issuer thinks, say initially when he had issued the bond it was 8%, now say interest rate has gone down to 5%, so he would feel that instead of paying you coupon of 8%, he can call this bond and issue new bond at 5%. So that's where the callability features come into the picture. So like in a way, it is a right to a bond issuer, and being a bond holder, we sell this option, so we earn something. So we earn some premium. We'll see that slightly in next slide. And if I talk about puttable bond, so puttable bond is like we are being bond holder, we are buyer of the option. So we think that if interest rate increases very high and my bond prices go down, so if I'm bond holder, I would think that bond price should appreciate. But if my interest rate goes up, then I will feel that like my bond prices prices decreasing significantly, making me super losses. So we buy an option. If decreases then further level, then we can sell it off to the issuer. So this is about callable and puttable bond. Callable bond, in a callable bond, let me just write callable bond and puttable bond. So let me write who is a buyer and who is a seller of the option. So when you are callable bond, the buyer of the bond is seller of the option. And in callable bond, like a bond buyer, let me call this as a bond buyer, and bond issuer or seller. So if I categorize this in this way, so seller of option and issuer is buyer of option, because he can call debt at any point in time. So that's about the callable bond. In a similar way, for a puttable bond, bond buyer is buyer of option, because we think that the bond price will decrease. We have bought a put option so that we can sell the bond, and the bond issuer is seller of the option. So little bit of mechanics on embedded options. Please make a note of it or take a snap of it for your reference. And now most important one, like as I said that to answer this question, you need to understand table bond, callable bond. You need to understand Z spread. So now we are touching upon Z spread. So Z spread is that spread which when added to the interest rate, so they say this is your YTM. So currently say your bond is trading as 95. But when you discount at your interest rates, so now you have got term structure. So this would be year one, this would be year two, likewise nth year. But when you discount your coupons and say coupon plus principal on maturity, then it gives you 90, say 96, just for example. Then what happens? You have to add some extra spread to bring this price down to 96. That spread is called as a Z spread. Basically, that is like this you can think of as a premium for having credit, liquidity, and optionality risk. So this Z spread has three categories. One is credit risk, liquidity risk, and optionality. So when you are giving an option, what the options that we talked about in the previous slide, what is the value of that? That's the Z spread along with credit and liquidity spread. So if I write it mathematically, Z spread is option cost, the options that we talked about, and the remaining portion is option adjusted spread. So this consists of your credit risk and liquidity risk. So whatever premium or returns that you expect to bear this risk, credit and liquidity risk, it's categorized under the optional adjusted spread. Whereas option cost falls under the, so it's if you like from Z spread, the total Z spread, if you subtract the option cost, that's where you are left with the option adjusted spread. I mean, what is a spread that is left after adjusting the option cost in Z spread? And finally, it's relationship between Z spread, I think we covered, but yeah, you can just visualize. This is a total Z spread. The length you see is total Z spread, which is has been flagged here. And under this, you have got some option cost over here. And if you subtract this option cost from Z spread, you get option adjusted spread, and which is mainly for credit risk and liquidity risk. Okay. So, and as I said that from buyer's perspective, call option cost is positive because you are selling something to the issuer, so you will earn something. So it's a positive number. But when it comes to put option, then eventually you are uh, buying an option. That's why it would be negative for a put option. So now let's go back to our question and understand what's the mechanics is. So be very careful, slightly tricky question. So when I say that Z spread is equal to option value, what is option price, option value plus option adjusted spread. So you can just think of this line as the entire category, entire distance is say Z spread. Okay. And under this, there are say pieces. Say this is option value or option price, and this is OS, option adjusted spread. So what happens that when we talk about callable bond, so first of all, we are saying that this bond is trading at par. Okay, so eventually we are talking about this territory. Now, in this case, usually your call price is kept as 100. So whenever your price reaches to 100, usually issuers try to call the bond because they can reissue the debt at a lower rate. So usually it tends to reach to the 100. So what happens that when it's in this territory, when your interest rates are going up, when your interest rates are going down and bond price is going up. So in that case, what happens that the the value of the option goes up. So this particular thing goes up. So if my Z spread is if my Z spread is constant and this portion is increasing. So if you look at this option value, if this should get shifted here, okay, then in a way your option adjusted spread is decreasing. Okay, because when callable bond trades at a par, then option value increases. So your option value is increasing. That's why your option. So eventually, if C spread is constant, okay, because you're assuming your credit and liquidity risks are not changing. So entire Z spread would be constant. So in a way, your option adjusted spread will decrease. That's what the statement first is saying. Option adjusted spread is less than Z spread for the callable bond. Okay, and like statement C is contradictory, so this cannot be true. And because we have got one true, this won't be true. And so when we talk about trading at par, usually option value. So like if I talk about puttable bond, so when you are trading in this territory, almost your option value is zero. So in a way, your option value is zero. So there is no optionality value. In fact, your entire Z spread could be equal to OS. So in fact, it's other way around. I mean, some like not other way around, but these could be equal because eventually there is no optional option price or option value because when bond trades at a bar, of course, no bond holder would like to sell. Like he would think that let it increase more and I'll make out of it. I'll make more money out of it. So this is also not correct. The correct answer is Option A, the simple reason, just visualize this distance line. When you're nearing the callable territory, this option value will go high and this will slightly get narrow. So option adjusted strap will become narrow. So that's how it can be thought of. Hope the video was useful, and there are three concepts covered in this. So yeah, please do share with your friends, colleagues, and peers who are preparing for FRM, CFA, fixed income specifically. It will be very useful to them. And yes, stay connected with the channel. And yeah, thank you. Staying connected.